Hello, this is Bill Moreland with Bank Reg Data. I wanted to do a Flagstar Bank Q4 update. One of the most watched videos from last quarter was a Flagstar review that I had done talking about how I'm not too optimistic about their prospects. So my plan was to do that this week, and then lo and behold, I got my email from the American banker. Flagstar CEO says his bank could be attractive. I'm not sure attractive would be the phrase that I would use, but as I've been telling clients for a number of weeks now, I think there's a very good chance that this bank probably gets merged out within the next few months. It'll be billed as a success. It'll be pressed. The press will basically say that this is, a good merger. I think Flagstar is very much a candidate for going under, and I don't think they're going to let Flagstar go down. All right. So put in FLG to bring up Flagstar. And what we see here is the mergers from a couple of years ago where they basically jump up. The big change here is notice the FTEs. We basically have dropped from 8,301 to 7,258. So there have been significant 850, 900 people have lost their jobs at Flagstar over the course. Very much a scale down. If we look at total assets, we can see the numbers dropped from 114 to 100 billion flat. Loans have gone from, if we come back here to the peak, 85.9 to 82. It was slow, but then all of a sudden we see two major drops quarter in, quarter out. They're basically selling off whatever assets they have in this organization that they can basically get money for. Come down, we can see our tear sheet. Asset quality is all orange. Liquidity is all orange. Funding and net interest margins orange. Income and expenses orange. They're just not making any money at all. Scroll down to our threshold alerts. And this is probably one of the highest number of alerts that we've had for a bank. Especially for a larger bank. I don't know if I've ever seen one. So when it's a major alert, that's going to be in the bottom 7 to 10% nationally on that metric. And the ones you see here are asset quality, exposure, asset quality, asset quality, asset quality, liquidity, quality, liquidity. I mean, it's just they're firing off on liquidity. They're firing on asset quality. The big one, probably the one that's most alarming to me, would be the coverage ratio. That's how many dollars do they have of reserves for every dollar of NPLs? They got 41 cents. So we're going to go ahead and cycle through. The main thing to look at here is, I've said this before, we've got a number of banks that are commonly heard is, yes, things are going to be difficult, but banks are higher. They got higher capital levels than they did last cycle. I'm going to illustrate how that's not always the case. So Tier 1 capital, last 10 years. You come in here. If you ever see a bank with a 10 handle, almost always within a couple of quarters, the number is going to go up. And you can see that it went from 10.697, whatever that ratio was back in 2015. And then within a year, the number had jumped back up to 11, 12, 13. And then it slowly worked its way down, gets another 10 handle. And now all of a sudden, lo and behold, we're at 13.24%. So we are more capitalized than we have been in 7 years, right? You have to go back here to 2017 Q4, 2018 Q1 to get that levels. That's an illusion. That is not going to be, they're not better. They're not more capitalized. Basically, they've shrunk the bank, as we saw that a little bit earlier. They're shrinking assets. They're shrinking loans. And the reason behind that is they want to shrink their risk-weighted assets. They've gone from 85.7 billion to 75.8 to 67.5. And the reason the Tier 1 capital ratio is going up is because they're shrinking the denominator. Remember, there's a numerator, there's a denominator. Both those things can impact the ratio. If we actually look at real capital, they're burning capital, and they continue to burn. 9.69 billion, 9.45 billion, 9.3 billion, 9.1 billion, a little over $8.9 billion. So this bank is burning through capital. And yet, with the magic of shrinking the bank by selling off loans, basically they can report that they're more capitalized than they've ever been. Have been in a while. We also see that same illusion with allowance. If I come into asset quality and I come into allowance, we see that their allowance numbers up here in dollars have climbed from 620, 992, 1.2, 1.2, 1.25, a little bit down. But as a percentage, you can see that they're working their way back up to 1.72 and 1.69%, which once again, more reserves than we've had in a long, long time. The problem is these numbers, the losses that are stacking up, that are going to have to be taken either through loan sales or charge-offs are going to dwarf these numbers. And so we'll work through this. Asset review, we can see that they're sitting on a very large amount of cash. Their securities portfolio is small. Net loans and leases continue to shrink, right? So cash is way down and loans are way down. And if we basically come in and look at cash, the number was going up. And that was probably the only thing generating income. If we come into yield in securities, we can see that that's primarily cash at the, balances due. That's primarily going to be cash at the Fed. You hear me continue to say that. And so banks were loading up on cash. They're generating $200-300 million worth of income from the Fed's IORB. As that number comes down, the income generated from that comes down. And so what's happening is they're shrinking, right? They're shrinking the asset side of the business. Are they losing core deposits? Yeah. So there's the acquisitions. And we see that core was making a little bit of a comeback, and now it's basically shrinking back down again. But that's not enough. If we come into liabilities and equity, were they taking any BTFP? Most likely. That's probably what that big jump is. Could have been something else. Actually, no, it had to be something else because that was after the 2024 Q1 deadline. So I don't know what that was, but very clearly they were tapping into some kind of other funding, and they've given it all back. And not only are they giving it all back, they gave back whatever they had before. So if you're going to shrink assets, you have to shrink liabilities in conjunction with that. And we also see another $5 billion drop from $18.25 billion to $13.4 of FHLB advances. So if you want to basically shrink the bank, sell your notes, get rid of cash, take your advances back, take your other borrowed money back. So we see that the bank is very much in a consolidation mode. Their mark-to-market losses, frankly, are not something that I would even really worry about with this bank. Their securities, as we saw, their securities portfolio was small. I think at 10% is what we saw on the balance sheet. And realistically, their losses as a percent of capital are not massive. This is not going to be enough to move the needle. The liquidity event is not going to be what creates a problem for this bank or an insolvency for this bank. The really problem, as we've identified, is their loan portfolio. So total loans, clearly they've been shrinking it quite aggressively. But if you look at the red chart and you look at the gray chart, red is delinquencies. They're clearly not selling delinquent loans. And I could tell. I could come into Bank Home. I could go to loans held for sale. There they basically put the flag out, right? They put the sign out that we want to sell. $7.8 billion was loans held for sale. 1.4 of it is mortgage banking activity. And that meant 6.42 is the rest. And it's pretty common after acquisitions. But very clearly they were telling a lot of people that they wanted to sell notes. Was it delinquent? Yeah, actually quite a bit. Quite a bit basically did have delinquencies associated with it. What we're not seeing, however, is that they're selling that. So loans for sale, this include the mortgage banking. And we know mortgage banking is not going to have delinquencies. So really you got to look at that 6.4, 300, and 445. They are selling them because that number is working its way down, but it isn't the delinquents that are being sold. So they're still sitting, they're wanting to sell them, but they can't. Are they selling non-accrual assets? Wow. So they are actually selling a lot of delinquent notes, but the delinquencies keep climbing faster. So their aggregate non-accrual assets, actually, you can see that they liquidated $332 million worth. but still the drop was only 3.29 to 3.14. So actually I stand corrected. They're selling a lot of delinquent notes. Are we seeing an impact on their income and expense, non-interest income, loan sales? All right, so it's hit and miss. So what's happening here is when you see a negative, that means whatever losses they took on their stressed delinquency notes far outweighed whatever income they were generating on mortgage banking activity or some kind of syndications, and notes that were seed corn, right? Performing loans that they basically could make a little bit of money on. So you do see that they were taking hits, but in Q4, that's not part of the problem. So let's go back to loans. So this delinquency would actually be even higher without selling some of the delinquent notes that they had out there, and it still continues to climb. We scroll down, we can see what the portfolios are, every one of them. So the way to read this is $34 billion of multifamily is their largest. It makes up just under 50% of their loan book. Non-performing loans are 90 days past due accruing fee and interest income plus non-accrual. So they have an NPL rate of 529 basis points. C&I is 206. I mean, every one of these is high, right? The only one you probably don't have to worry about, as I commented earlier in the Q3 update, is their 1 to 4. There's probably a lot of guarantees on that. But let's cycle through. So there's the multifamily notes. Basically, there's their C&I. So you can see they're selling them all off. There's their non-owner and big drops there. 1 to 4 family, a little bit of drop there. All other loans, we can kind of come back to that to see what are their issues. But let's pop back to multifamily. We're going to go look at early stage delinquencies. Yeah, they got a lot of loans moving into early stage. And if we look, they're red across the board right here. This chart right there is what I'm looking at. Every single portfolio is basically running, even leasing. And we talked about leasing last quarter. It's portfolios that you wouldn't expect. They're all starting to fall into delinquency for them. And it's not just them. It's across the board. But this bank is having more problems than most. Non-performing loan is enormous. Total delinquencies are massive. So if we look at their multifamily portfolio, you go back here, that's where they were telling everybody they weren't having many problems. But that number is up $900 million in delinquencies in 1 quarter. And they're taking charge-offs. They're taking a lot of charge-offs. But it's just wave after wave of delinquencies coming back in. C&I, same issue, right? NPLs are high. Total delinquencies are high. Non-owner occupied, still elevated. CRE owner occupied, there's a big jump, right? So there's another $33 million jump. Home equity loans continues to be very elevated. Just portfolio after portfolio after portfolio having issues. So the next area of trouble would be modifications. And really what we're worried about here is how many they're putting on an extend and pretend. So there's a $122 million note. It basically is still accruing fee and interest income. And it does look like it's paying down a little bit, not much, but a couple $100,000 every quarter. So at least they're there. But that is a note that is modified, but is not basically put on non-accrual. We do see their residential is starting to climb. And I got to believe that those are all government guaranteed, which raises other questions. And then there's their non-owner occupied, which they were doing a ton of them. And then basically they were dipping back into non-accrual. So I'm going to guess they're selling a lot of non-owner occupied is probably where their sales are coming from. There's no way to know. So the main issue with this bank is they've got a ton of losses. They're showing a lot of capital, but we know that they're burning capital. It's just manipulating the denominator. We know that they're showing we have more reserves than we've had for a long time. Right? But that's not the right ratio to look at. The right ratio to look at is the coverage ratio. And this basically measures how many dollars of reserves do you have for every dollar of NPLs adjusted for government guarantees working its way through the system. So even though we know they're selling hundreds of millions of dollars of delinquent non-accrual notes, as we've already identified, the numbers just keep climbing and climbing and climbing faster. So they're trying to bail it out, but the water is coming on board faster than they can bail with the NPLs. So the 41 cents on the dollar is ridiculously low. For a bank this size to have that kind of coverage ratio, you can see they've never been that low before. They're just not reserved. We come in and we take a look at all the banks around them at $100 billion. They're the bottom by almost half, right? Western Alliance is not a paragon of being well reserved, and they're half that number. Come down to the largest banks, they're in the 97th percentile. If we look at just the UBPR1 banks, they're last. So of the UBPR peer group 1, which is the FDIC's big bank peer group, they're last, not even close. And realistically, these banks down here, these banks down here are not typical retail commercial banks, right? So they're dramatically lower. Even worse is if we adjust for loan modifications, the number's sitting at 39 cents on the dollar. Once again, some of the lowest numbers out there. So they're clearly trying to shrink the bank. There's really no foreseeable way that this bank is going to make money anytime soon. Their losses are coming down, but that's because they're not taking as many charge-offs. And they're not really, nothing in provision, right? That number should be allowance is a bucket of reserves. Provision fills that bucket. And what we're seeing here is they're not filling it. They're taking hundreds of millions of dollars of charge off, 222 million, and their provision was half that. Typically big banks, they'll refill their provision dollar for dollar unless they got a lot of recoveries. Loans 2012, recoveries, not enough. Not enough. So they're still 80, 90 million light. And that's why provision's going down, or that's why allowance is going down, right? That's why it basically went down $80, $90 million, is they did not refill the allowance bucket. So if we come down here and we look, basically this bank is not setting aside enough provision. We already know that because they're under reserved, but they're setting back lower provision than they really should have based upon net charge-offs going. So realistically, they can say that they're making it more profitable, but it's an illusion. It's not. So I'm not real optimistic about this bank. Last quarter, I said I'm not in the business of saying banks are going to fail or succeed. I'm kind of in the business now, or at least I'm moving more into the camp of saying I don't think this bank is going to be a standalone entity for too many more quarters. As always, if you have any questions, please reach out and give me a call or drop me an email. Thank you.